All right. Hello, everybody. Good morning and welcome to this masterclass. I want to say we are excited. We are happy that you have joined us today. It's going to be an exciting session. I want us all to be open-minded. My name is Kemi Moye. I'll be moderating this session, and I'm not here alone. I'm here with a seasoned expert, somebody who has gained vast experience in this field of taxation, Olamilekan Yusuf. Although I'm still going to introduce him, but before we go ahead, I would like us to drop our names, where we are joining in from, and what sector we play in. Yeah, I want to know what business sector you play in. We just want to do a bit of networking. You never can tell. There may be somebody in the comment section or in the chat box that is willing to do business with you. So kindly go to the chat box and let us know who you are and what sector you play in. I don't know if you can hear me. Probably we should start by saying I can hear you in the chat box. I want to see 2 or 3 responses. Just say you can hear me. I can hear you. Thank you, Abidemi Sokpeju. Modupe Ola Odusomo, thank you. Comfort Oni, thank you. All right, so you can all hear me. So let's just move forward and introduce ourselves. Let's know where you are joining from and what business you are into. Shegun Jemilo, thank you. Yes, let's keep it coming. Your name, where you're calling or where you're joining from, and the kind of business you do. I'm still waiting for us to do that. I'm still waiting for everybody to do that. Thank you very much, Abidemi. Abidemi Sokpeju from Lagos is a computer technician. Yeah, you can look him up. Thank you for joining. Yeah, we want to have more people introduce themselves before we proceed to the business of the day. Olufadike Olaiton, good morning. Thanks for joining. Comfort Oni from Lagos State, thanks for joining. Bamishe Asogba, really do appreciate you for joining in. Wasiu Ayomide Modupeola Osudosumu, thank you so much. We really do appreciate you for joining. We appreciate your willingness to want to gather more, to learn more in order to scale your businesses. Thank you so much. I think we are going to wrap the networking up and move straight to the business of today. Shegun Jemilo from Lagos, thank you so much for joining. All right, like I said before, my name is Kemi Moye. I am the SME officer here at Lagos State Employment Trust Fund. And I would like to give a brief introduction of the Lagos State Employment Trust Fund, what we do and who we are. The Lagos State Employment Trust Fund was created or established in the year 2016 by an act of law, and we're saddled with the responsibility of reducing unemployment, to tackle unemployment through job and wealth creation. And the areas of focus, although not limited to these areas, are one, providing affordable finance to businesses in Lagos State. We also support youth in Lagos State through vocational and technical skills. So we don't just train youth, we also place them in jobs. And we also develop and implement policies to support people who play in the tech ecosystem. And not just that, we are also very keen about your businesses. We also support businesses in terms of capacity building through master classes as this, access to markets, legal and HR clinics and all of that. So that is who we are at LSCTF. And like I said before, we are not just limited to all of these that I've mentioned. We have so much interventions and programs for business owners, for residents of Lagos State. And just to thank you very much for all that have joined. Ahmed Owolabi, Kayode Ojo, Yunus Najim from Kaduna. Oh, wow. Thank you, Yusuf Najim from Kaduna for joining. And just to move straight to the business of today, our topic for today is tax planning strategies for business owners. Tax planning strategies for business owners. It is very important that we note that taxation is a very integral part of business planning. Very, very important. And in this section, we have a very seasoned expert that will be doing justice to that topic. Yeah, we'll be doing justice to that. And those business owners, if you ask them what they want, what their needs are, the first thing they tell you is we need money. But it is not just money. There are also information that we need to leverage on as business owners that will position those businesses to a point where you are able to access opportunities, you're able to get loans, you're able to get grants, you're able to get as many interventions as possible. So we are trying to prepare you to position those businesses in order to get all of this. Nana from Lagos Island, thank you for joining in. And so straight to the business of today, I would like to introduce our guest speaker for today. Yes, I know if you have joined one of our sessions before, you should know that we don't bring in just anyhow individuals. We bring in people who are experts in the field of topics we are discussing. And so today, we have joining in live Mr. Olamilekan Yusuf. Olamilekan Yusuf. I want to hear the drum roll. I don't know how you want to do it. I know we are live. But seriously, when I went through his bio, I was like, wow, this is in fact somebody that we would learn a whole lot from. Yeah. Isaac Newton once says, if you want to look further or if you want to look farther, you have to stand on the shoulder of a giant. So this morning, our giant is Olamilekan Yusuf. And I want to assure you that you're going to get insightful tips on how to scale your business. So Olamilekan is a tax and finance professional with over 8 years of quality training and hands-on experience in delivery of a wide range of corporate tax services to clients around or across various industries in Nigeria and the United Kingdom. He has worked on several tax advisory, tax audits, and financial reporting engagements involving clients in the financial services, telecommunication, consumer goods, and pharmaceutical industries. He is an associate member of the Institute of Chartered Accountants of Nigeria and Chartered Institute of Taxation of Nigeria. So that is our guest speaker for today. I want us to be open-minded. Get your writing pad, get your notes, your pen, your jotter. It's going to be a smooth ride, I assure you. And at the end of the, yeah, thank you, Bami Shayi. I can see the drum is rolling already. All right, so I want us to also get our questions ready. At the end of this presentation, you would be given opportunity to ask questions, clear gray areas, and then seek clarifications. And but before we get to that, I'll just leave the floor open for Mr. Olamilekan Yusuf. Thank you for joining in, Mr. Lekan.
Thank you very much for the introduction, Martha. And please confirm you can hear me, please. Hi, Martha, can you confirm you can hear me? Hello?
Mr. Olamilekan, we can hear you.
Oh, okay, beautiful. Thank you very much. And once again, thank you for the brief introduction. And I would like to say welcome to everybody for joining the session. And I'm hoping that by the end of the session, we would all be able to gain one or two things and have a significant takeaway with respect to a positive mindset towards taxation and tax compliance, as well as tax management with respect to our businesses. Um, just like Martha has said, taxation is essential for business owners, just like the way knowing how to sell your goods and knowing how to collect your payment for the goods you have sold. So what the Lagos State Employment Trust Fund is trying to do today is to help everybody to just have a basic understanding, a basic overview of what a tax person should, a business owner should be doing with respect to taxation. And I've been called upon to help do justice to that, and hopefully I should, by the end of the day, to have done justice to that. So allow me to share my screen so we can start off. Okay. Once again, I'm welcoming everybody to today's masterclass session. And the topic for the session is tax planning strategies, especially for business owners in the country and in particular in Lagos State. One of the caveats I would like to give is I'm aware someone is joining us all the way from Kaduna, and we appreciate that. However, to a very large extent, majority of the taxes we'll be talking about would revolve around Nigerian taxation as a whole, and some will be specifically be referencing the Lagos State tax laws. So I would want to mention that just because of the person joining us all the way from Kaduna. But all the same, if you have any question that you want to ask that might be a bit not related to the state you're joining from, we're happy to shed more light on it. Okay. Once again, a bit background about myself, just like as Martha has introduced earlier. I am Olamilekan Yusuf, and I am a member of the Institute of Chartered Accountants of Nigeria, and as well as the Institute of Taxation of Nigeria. I started off my career at PricewaterhouseCoopers, where I'm opportune to gain experience that cut across both finance and taxation. And at the same time, I have had the opportunity to work in the fintech space in Nigeria, where I was the finance controller and as well as the tax controller. But currently, I'm based in the United Kingdom, where I worked for an insurance company as the senior group tax accountant with my responsibility covering the United Kingdom, Australia, Hong Kong, and as well as New Zealand. I'm not new to volunteering to help Lagos State and the people in Lagos State. I have also been opportune to be a training facilitator for the Lagos State Ready Set Work program, a project that was mainly focused around helping final year students prepare themselves for the employment world and also prepare them for the challenges ahead, which is a bit different from what the academic world teaches the final year student. And also, I am a football lover. I support Sporting Lagos and as well as Arsenal. And I'm hoping that by the end of today, when everybody have been able to gain one or two insight around taxation, I can go back and watch my Arsenal winning their match today in the Champions League. Sorry, I had to just check that in. Okay, so for today, the learning outcome, rather, or the objective of this masterclass is to ensure that people that have joined us, the participants are able to gain insights into how to navigate complex tax regulation, and at the same time, what are the compliance requirements. So when we say compliance requirement, we are saying what are the things that you are required to do as a business owner with respect to taxation in Nigeria and with respect to taxation in Lagos State. Also, at the end of the session, participants have been able to equip themselves with practical and tactical ways of minimizing their tax liability and exposure, which at the end of the day would allow the business owner to achieve the overall profit maximization, which is one of the key reasons why everybody set up the business. Also, we would also have been able to gain a comprehensive understanding of tax planning strategy and what you should be doing to help you to be fully in compliance when it comes to taxation in Nigeria and in Lagos State as well. Just before we dive into the content with respect to what we are trying to do today, I have decided to quickly do a brief intro with two case studies. And I just want to use the case study to show us how beautiful and how interesting taxation can be, looking at it from an angle of a tax situation or a tax scenario, how we can see the complexity and at the same time how we can be able to see how doing the simplest thing, the simple thing can hinder or at the same time or can help build or improve the business. So looking at the first scenario, we have a businessman who is Amzat. I'll try and read through the scenario and then break down the content. So we have Amzat, who is a business owner who has been trading for several years. However, Amzat does not pay taxes on his income. Amzat has just won a contract for supply of goods for an ongoing construction project. It is estimated that Amzat will make a profit of about 4 million naira from the project. To execute the contract, Amzat needs 12 million naira. That is the total cost of doing the contract that he has just won. However, while at the current stage, Amzat only has 3 million naira in his bank account, and is about to, so because he has 3 million naira and he needs actually 12 million naira, so that means he's short of 9 million naira. So Amzat needs to raise an additional 9 million naira from the bank, which would then allow him to be able to carry out the project. And at the end of doing the project, Amzat would have been able to make a profit of 4 million naira. So as part of the loan requirement from the bank has asked Amzat to submit his TCC certificate, which is a tax compliance certificate. Usually, when you approach a bank, it is usually part of the requirement for you to submit your tax compliance certificate so that the bank can see that, even though as the business is doing fine, you are also in compliance with the tax law. So which means the bank will be more, their money will be more secured on the basis that they are not giving their money to someone who is not managing his business right and doing the necessary thing with respect to laws and regulation of the land. Unfortunately, because Amzat could not provide the TCC because he doesn't pay his taxes, he was unable to raise the loan and the contract was cancelled. Looking at it, just because Amzat is not doing what he needs to do as a business owner, which is pay his taxes, he was unable to make a simple 4 million profit from a simple project where in a very short time he could complete the project and make a 4 million naira project. So what I'm trying to say here is that as a business owner, from the moment you start your business, it is very important and essential that you have it at the back of your mind that being compliant with the tax law is one of the key reasons for your business success. Because if we're in a situation where you are not compliant, it could mean that you could be losing more, thinking you're gaining more by not paying your taxes. There was a survey that was done by Faith Foundation where the Faith Foundation reported that at the moment in Nigeria, roughly about 55% of SME business owners does not pay taxes, while the remaining 45% does. And if you look at it, assuming we say we have about 10 million SME business owners in Nigeria, this simply implies that roughly about 5.5 million 5.5 million business owners are not paying taxes. And this simple scenario that just happened to Amza could easily happen to any of the 5.5 million people that are running business in Nigeria and at the same time not paying taxes. Then the second scenario is a bit technical and complex, but I'll try as much as possible to break it down for us to appreciate what the scenario is trying to point out. So in the second scenario, we have Chidera, who is a female microinsurance startup founder. And when we say microinsurance, we are saying an insurtech company. These are people that probably set up a microinsurance business where people does not need to go through intermediary brokers, i.e. insurance brokers, for them to place their insurance or for them to make claims for their losses. So a smart person and a techie savvy person in form of Chidera decided to build a micro insurance company, a tech company where people can log in online at the tip of their computer or phone. You could easily just place an insurance policy for your car, for your business or anything, and your insurance policy starts running immediately. So, but however, she's in the process of selling the insurtech company to a big insurance company in Nigeria who are looking at expanding their micro insurance business operation. Let's just say, for instance, there is a big insurance company in Nigeria because they have seen that, the tech people that are beginning to set up a micro insurance and everybody's tapping into it and they've seen the potential and the growth in the micro insurance. So they've decided to buy an existing company and they've identified Chidera's business, which they are going to buy. The insurtech company net value is at 300 million naira, and the insurance company is willing to pay Chidera the full valuation, which means they are willing to pay Chidera the whole of the 300 million. However, to protect their investments, the insurance company inserted a clause in the sales and purchase agreement. So usually when a company wants to buy another company or a business, that's usually an SPA, which is the sales purchase agreement that comes between the buyer and the seller, right? And in the SPA, there's an initial consideration of 200 million naira to be paid to Chidera, while an additional 100 million naira will be paid in 2 years later, provided Chidera remains in the business until then. Therefore, the clause, which is Chidera stays with the business for additional 2 years and gets the remaining 100 million, or if Chidera does not stay for 2 years, Chidera then forfeits the 100 million. This is a very common situation in business acquisition. I'm sure if anybody's familiar with the tech space, there was a time where Paystack was sold to Stripe, and the owners, the people that sold Paystack, still remain in the business even after they've sold the business. So there are sometimes this is done because the person that started the business, i.e. a Chidera, understand the business more, understand the market, understand the environment, and it will be better for the buyer to maintain and keep Chidera so that Chidera can easily help them to grow and transition the business to whatever the new buyer wants to achieve with it. So because of that, a clause of 100 million naira was inserted. Now, the thing is, Chidera signed the agreement, and 2 years later, the insurance company was about to pay Chidera the 100 million naira, and then they seek professional tax advice. And the advice was to them was that at the point of paying Chidera the 200 million naira, rather than applying capital gain tax rule, they need to apply personal income tax rule on the 100 million naira and deduct pay on the 100 million naira. Now, the thing is, rather than deducting CGT, which is at the rate of 10% on 100 million naira, and Chidera would have just paid 10 million naira as capital gain tax. But because of the clause, and because Chidera on her own did not seek professional advice or does not understand the clause, the implication to her at the point of signing the agreement, she is now exposed to a tax of over 20 million naira, where she could have easily just paid a tax of 10 million naira, depending on the wording of the clause in the SPA. So what this scenario is just trying to tell you is that a simple agreement that you decide to sign without evaluating the tax consideration or the tax potential or the tax impact could easily mean or could easily put in a position where you end up paying additional taxes rather than paying lower. Now, there is no, it's not a bad thing, or there is no rule that says you should pay the right amount, that paying the right amount is wrong or bad. Overpaying is what, as a business owner, you don't want to do or you don't want to expose yourself to, where you could easily pay the right amount. Now, Chidera paying 10 million could also have been the right amount, and at the same time, Chidera paying above 20 million could also be the right amount. It's just dependent on whatever Chidera has done to ensure that, oh, if paying 10 million is the right amount, taking the professional advice and taking the right, what is it called? The right tax advice and considering the right implication could have easily made it possible for Chidera to have paid the right amount rather than paying 20 million, which is over and above. Now, I know that people could have questions around this. This is a bit technical scenario, which is why I'm putting this point here to say that if you want to gain more insight or understand the technicality that revolved around this simple or complex scenario, you need to look at there's an accounting standard under IFRS 3 that talks about continuing employment and easily talks about what makes a consideration post-combination service or an additional consideration payable. I would not dwell into it. I just try to show us a scenario of how complex tax can be and how simple taxation can be at the same time. If you have any question, please drop it on the chat box and I would gladly come back to it and respond to the question. So after the case study, we can then go into looking at the overview of applicable taxes to business in Nigeria. And in looking at the taxes that are applicable, I have tried to break it into a 3 simple format, which is taxes that has to do with income that is being made or gain that is derived from a particular activity, or income that is made as a result of taxes that is paid as a result of employment, or indirect taxes that are paid as a result of transactions or activity that has happened. And then I'll try and touch down on some other applicable state taxes which are applicable in Lagos State. Start off, I'll be starting with company income tax, which is usually called CITA or CIT. Now, for company income tax, a a company registered in Nigeria is liable to taxes on on income tax. Now, when I say company, I'm referring to companies that are incorporated as a limited or a PLC, which is a company that is incorporated with Corporate Affairs Commission, and it is incorporated not as an enterprise or as a business name, but rather as a limited or a PLC. So such companies are liable to taxes in Nigeria on their worldwide income, which is in relation to profit that is accruing to them from all activity, or profit they derived within Nigeria, whether profit you derived in Lagos, profit you derived in Abuja, profit you derived in Kaduna or Port Harcourt, as well as profit that is brought into Nigeria. As long as the business is the one that has gone outside Nigeria to carry out a transaction and make additional income, such profit will be subject to company income tax in Nigeria. While a foreign company that carries out business activity in Nigeria would also be subject to company income tax. However, this would only be restricted to company that is derived within Nigeria only, right? And for company income tax, the assessment is based on preceding year basis. Now, when we say preceding year basis, is that the tax law assess you to tax based on your activity in the preceding year, i.e., as we are in 2014, if a company financial year ends in December 2014, the company will be assessed to tax for its activity from 1st of January 2023. Sorry, I said 2014, 2024 rather. Such an business will be assessed to tax from 1st of January 2023 all the way to 31st of December 2023. So which means in 2024, such business will be assessed to the profit that has been made or income that has been made in the prior year of assessment. And as a result, the business will be required to file its income tax returns within 6 months. That is from the end of that accounting year, which is 31st of December 2023, the business would have all the way up to 6 months, within 6 months to then file the tax return relating to that preceding year. That is from 1st of January 2024 all the way to 30th of June 2024. The law says within, so it doesn't necessarily mean as a business owner you have to wait all the way to 30th of June to file your return, but you can file it even on the 1st, provided you have your document ready. And what are the documents that is required in filing this return? Essentially, there are just 2 things that you need to have, which is your account. Now, for a company that the turnover is less than 100 million, definitely the account does not need or is not required to be an audited account. However, where your turnover is exceed 100 million, then the account that will be filed for your CIT return, your company income tax return, has to be audited as well. In addition to the account, you also need to prepare your tax computation and file it along with the audited account for a company that the profit income turnover is above 100 million. Now, for CIT, the rate that is applicable in Nigeria, courtesy the Finance Act, is in 3 different rates. And for a small company in Nigeria does not pay taxes on its income because a small company is CIT rate is applied at 0%. However, a small company based on the Finance Act is defined to be a company with an annual gross turnover of 20 million or less. So as a business owner, if in 1 year all your revenue, which is your turnover, all your sales that you've made is less than 25 million, then you will not be required to pay company income tax. However, you're still required to file the return, which will show that you did not make up to 25 million, then therefore you will not be paying CIT. However, for a medium-sized company, which is defined under the tax law to be a company that the gross turnover, which is your sales, is between 25 million to 100 million, right? When you make between 25 million, but you don't make more than 100 million, right? And so you made up to 99.99 million or 99,999,000. So that is where you then pay 20% company income tax. While for a large company, that the turnover, the gross turnover is from 100 million and above, then such company will pay income tax at the rate of 30%. Now, remember, I mentioned that for a small company, you don't pay SITA. However, you'll still be required to file your returns because that is the only way the FIRS, the tax authority, will be able to know and ascertain that you have not met the threshold to pay income tax at either 20% or at 30%. Now, failure to file your return or late filing where you have exceeded the 6 months period where you should file your return, there is a penalty charge for late filing, which is 25,000 for the first month, or well, if you don't file and in subsequent month, you pay an additional 5,000 naira each. So say for instance, your return is required to be filed by 30th of June, but you fail to file it by 31st of July, there will be a 25,000 naira penalty that will be charged. And at the same time, come August, if you don't file again, there will be another 5,000 naira added to the 25,000, up all the way to the month you decide to file. So if you wait 1 year and you don't file, definitely you're going to pay 5,000 naira for an additional 11 months plus 25,000 naira. So this penalty would also apply to a small company that is exempted from paying company income tax but fail to file its return. In addition, where you are a medium size or a large company that did not file your return early and also did not pay your company income tax, you will be charged at a penalty of 10% of the unpaid amount plus interest payment. Usually, the wording of the tax law with respect to applicable interest for penalty is the MPR, which is the monetary interest rate plus a spread. But usually in practice, the tax authority apply the rate at 19%. With the way the interest rate in Nigeria is going, it's possible that in the nearest future or in some months to come, the tax authority can increase this interest rate, which would then bring it to be higher than 19%. But at the moment, usually in practice, the applicable rate is 19%. Going further on company income tax, there are still some other element of company income tax that a business owner is also expected to be aware of. One of them is the minimum tax rule. Usually, the minimum tax rule is applicable where a business has no taxable profit, or the tax payable within one accounting year tax period is less than the minimum tax compute. So what the law says is that when it is time for you to file your return and you've done your company income tax calculation, you are also to prepare aside a minimum tax computation. And then you now check that, oh, the amount that I'm liable to pay, is it below or above the minimum tax? So for instance, a business owner who has computed his tax liability, let's say a medium-sized business owner who is to pay CIT at the rate of 20%, right, has computed his or her tax liability, and the calculation, the tax payable is is 5 million naira, and then the same business owner computes the minimum tax, and the minimum tax is showing that you have to pay 5.5 million naira. So what the tax law or the minimum tax rule is saying that rather than paying based on your company income tax computation, you have to pay taxes based on the minimum tax, because it is assumed that at most for your business, you should be able to pay this least amount. The minimum you should pay should be this amount. So because the person has computed 5 million naira as his CIT liability, and the minimum tax exceed the 5 million, therefore the person will be required to pay the minimum tax and not the CIT that has been computed. And for minimum tax, it is computed generally on 0.5% of annual gross turnover of a business. This annual gross turnover is less frank investment. When we say frank investment, we are referring to income that is accrued to a business or received by a business that has already suffered tax, i.e., dividend. So where you have as a business owner, you have complaint A, complaint C, B, and complaint C, and you decide to pay dividend from complaint B to A. Such dividend income that complaint A has received will be exempted when calculating the minimum tax, because it is believed that it is a frank investment which has excuse me, which has initially suffered taxes. However, for minimum tax, there are some basic exceptions to it, and the exceptions make it possible for some business or business owner not to pay minimum tax within a particular period. I.e., one of the condition and exception is for the exception is that the business is within the first 4 years. So if you start a new business within first 4 years, the business is exempted from paying minimum tax. I.e., I start a business in January 2020, as we are in 2024, it means that my business from January 2020, January 2020, 2021, 2022, and 2023, my business would not be paying taxes or on minimum tax. We're in a situation my tax payable is lower or less than the minimum tax that has been computed. So that means where 0.5 of my total turnover, excluding frank investment, is, for instance, 2 million naira, and my tax is say 1.5 million naira. In my first 4 years, I will not be paying minimum tax, which means I don't even need to calculate or check whatever my minimum tax payable is. Also, a company that is regarded as a small company in Nigeria will also not pay, does not pay minimum tax. If you recall, I mentioned that CIT for a small company is at 0%, which means a small company that makes 25 million turnover in each relevant year is regarded as a small company and does not pay CIT. Therefore, such small company is also exempted from minimum tax. In addition, if as a business, your business is primarily agricultural trade, that means you are directly involved in agricultural business, right? And it is not a supply chain, i.e., I have a transport business where I help um, trade farmers to transport their crops or cassava from Kaduna to Lagos. Therefore, I'm also in agricultural trade, but in respect to the law specifically said primary agricultural trade, which means you are directly involved in it as a farmer. You do farming business, you sell agriculture, crops. Those are the people that are exempted, not in a situation where you are an agricultural intermediary or you just produce, you manufacture a tractor and sell it to farmers, and you such kind of business is not included. Furthermore, still on company income tax, there is also what we call deemed profit, right? The deemed profit tax assessment is usually applicable in a situation where the tax authority is unable to ascertain or determine the business profit, where a company does not submit its financial statement or financial account and does not file its return. However, due to reliable information that the tax authority has been able to gather, the tax authority can deem a profit and apply company income tax on such. So in that instance, where the tax authority is able to gather information with respect to your income, so in such income, the tax authority will then apply a 20% deemed profit on your total income. When they now deemed the profit, what they then do next is to apply CIT at the rate of 30% on it, which cumulatively gives you a 6% tax on your total turnover. A good example of this kind of scenario will be a content creator who doesn't pay tax or anything and did not prepare accounts to determine his or her income and expenses. However, there is a news that has been circulated that such person was able to enter into a sponsorship or influencing agreement with, say, MTN, and everybody is aware that MTN is going to pay such person 20 million naira each year. It simply means that where the tax authority is unable to gather information, or since the person has not submitted sufficient and reliable information to the tax authority, then they can rely on that information that you make such income and then deem the profit of 20% on that total money you're making, and then I expect you to pay a tax of 30% on the total income. Also, some other aspects which I've decided not to touch on because probably I can say there are a bit of high-level aspect, and when it comes to company income tax is what we call the excess dividend tax. Now, the excess dividend tax is a tax that is applicable where a company pays dividend. However, the dividend that has been paid is more than the income tax payable by the business. Also, with respect to excess dividend tax, there are still some other exceptions that would not make a company to pay excess dividend tax, i.e., where the company can prove that the dividend that is being distributed or paid to the shareholders or to the owners is coming from income that has already suffered taxes. So, i.e., it is coming from your distributable reserve, which is your profit after tax. It could be a cumulative profit after tax for several years, but the business would have to demonstrate to the tax authority that the income that is now being distributed is coming from the profit that has been taxed already. So in that regard, such income will be exempted from excess dividend tax. There are still some other instances that could make a business not to pay excess dividend tax. Also, there is what we call the transfer pricing rule. With respect to transfer pricing rule, this is a rule that is used to just assess the adequacy of transaction between connected or related parties, right? And to be sure that profit are not being shifted from one tax region or a high tax region to a lower tax region. Now, this is more common where you have a group of company, and you have several subsidiaries, company A, company B, company C, company D, and they are all under one controlling entities, and they then try to transact between each other. So because of the transaction that they all carried out between each other, FIRS or the tax authority would usually try to evaluate the transaction that is being done between this related party to ensure that these transactions are done at arm's length. They are done at fair value, and they are done at market value. So you don't then try to be loading expense in one company, and whereas the objective is to make sure that that particular company does not pay more taxes or thereabout. And the last one I will also talk about with respect to company income taxes, what we call the significant economic presence rule. Now, the significant economic presence rule is also an aspect of company income tax, but it is an aspect that deals with more of non-resident company, where you have a non-resident company, a foreign company that transact or carry out business transaction in Nigeria, and they are not registered for taxes in Nigeria. So what the significant economic presence rule does or try to do is to ensure that such foreign company is also brought into TaxNet in Nigeria. And there are some threshold that is used to determine it, and it is split into two. We have foreign company that carries out digital services in Nigeria, i.e., the likes of Amazon, the likes of Google, and the likes, where they carry out digital services that is done in Nigeria. Before now, if the likes of Google, they are not incorporated or they don't have a registered business in Nigeria, and they carry out all this business, provided they make more than 25 million in one accounting year, the SAP rule requires them to register for tax in Nigeria and pay company income tax on the profit that they derived in Nigeria. Also, the other aspect of it is the withholding tax that ensures that for a particular type of services, which could be professional, management, or technical or consultancy services, that is being rendered to a Nigerian company by a foreign company. The Nigerian company is then required, as a result of the SAP rule, to deduct withholding tax. I will come back later to explain what we mean by withholding tax, but to deduct withholding tax from such transaction and remit it to the tax authority. This rule is very important and significant for business owner who are more into tech environment, right? So for instance, you you decide to sit with your friends and you guys create a software, a tech solution for Nigerian business. However, you you engage with foreign companies, i.e. the likes of Eskimi to run advertisements, the likes of Alibaba or any foreign technology company that you engage um, to provide services to you in order for you to be able to run your tech business in Nigeria. So in such instance, the business owner needs to understand of the requirement of SAP and then be able to apply or deduct the required taxes when making payment for the services that has been rendered by these foreign companies. Moving further, other taxes that are applicable to business with respect to taxes on income, we have what we call the tertiary education tax, which is before now we just call it education tax. And this education tax is also similar to company income tax, and it is paid on by all company that is registered in Nigeria. However, again, as a business owner who runs a small business in Nigeria, you are also exempted from company tertiary education tax. And tertiary education tax is charged at the rate of 3% on assessable profit. Now, I highlighted the assessable profit. In Nigeria, when you're calculating your company income tax is paid on taxable profit, right? While education tax is paid on assessable profit. Now, the key distinction or the difference between taxable profit and accessible profit is that accessible profit is a tax adjustment or a tax adjusted profit after deducting, or rather before deducting capital allowance and tax losses. So when you're calculating your income tax, you would have done your profit and know what are the taxes and expenses or transactions that are allowable or not allowable. And when you bring in all the taxes that are allowable and taxes that are not, expenses that are allowable and expenses that are not allowable, when you bring all this into your calculation, you arrive at accessible profit. So it is this accessible profit that you apply 3% on before going to then do your capital allowance. And then if you have tax losses that you're bringing from previous year, you then remove all that before you arrive at your taxable profit and then apply whether 20% or 30% on the taxable profit. So in some instances, your accessible profit will be higher than your taxable profit, while in some instances, it could be the same, where you don't have capital allowance to claim or you don't have tax losses. I will come to this later on as we move further. Also, with respect to taxes that has to do with income, we have what we call the withholding tax. Now, to make a clear distinction, withholding tax is actually not a tax on its own. It's not like the way we have company income tax, we have tertiary education tax. Withholding tax is a tax that is embedded or a part of company income tax. So we usually say that withholding tax is an advance payment of income tax, which is deducted at source on specific transaction. Now, the good thing is that when your withholding tax is deducted or where you suffer the withholding tax, you can always apply this withholding tax as a credit when you are paying your company income tax. So what I'm trying to say is that I run a business. I do let's say I supply people with printing materials, right? I supply to companies, stationery materials. I supply them with Fusca paper, A4 printing paper, ink, toner, and every other thing. I supply things to them, and then I have a contract or I have an agreement with them that see for me to when I help you, when I supply you all these things, I'm going to charge you maybe um um 30,000 naira or 500,000 naira or 2% flat on the total amount of the goods I'll be supplying to you, right? When you supply them, at the point when the business is about to pay you on your invoice, what the tax law is saying is that they should deduct withholding tax from you where applicable if withholding tax is applicable on that transaction. And in turn, you then go back to your tax authority when you've been able to gather all your withholding tax evidence that you have suffered. You go back to your tax authority and then claim back the withholding tax as a credit when you are paying your company income tax. So that's why we say withholding tax is not like a separate tax on its own, which you can tell anybody that, oh, I pay income tax, I pay education tax, I still pay withholding tax. No. So the withholding tax you're paying will be applied or can be applied as a credit to your income tax. The reason or the major reason why withholding tax was created is just essentially to bring taxpayers who are not within the tax net, i.e., the business owners who don't pay tax, who are not registered for tax, is just to be able to bring them into the tax net and allow the tax authority to be able to get some taxes from them as they carry out their transaction, rather than wait till end of the year and then get the taxes from them when they file their returns, do their company income tax calculation. But to a large extent, there is a bit of challenge at the moment when it comes to withholding tax for small businesses. You would recall that I did mention that a small business does not pay taxes on their income, provided that they don't make more than 25 million in one accounting year. However, the withholding tax regulation or the Finance Act, the company income tax, none of this regulation or none of this rule had made any reference to a company that is regarded as a small company to be exempted from withholding tax because there is no specific regulation that can be referenced or cited. It is a bit challenging, a practical challenge to business owners at the moment not to deduct withholding tax from a small company, even though a small company is exempted from paying taxes. However, the only thing the small company can then do is that at the end of the year, when filing their return, the company can then claim back a refund, a credit from the tax authority to say, see, for this year, my tax is zero because I am a small company. However, I have suffered withholding tax of 500,000. And because I don't know when I will be paying taxes, that is because I don't know when I will become a medium-sized company to pay 20% taxes. I want to claim back this credit as a refund. So for the tax authority to then pay you back the money you have suffered. So there's a bit of practical challenges with respect to that. And for we tax professionals, we are hoping that subsequent finance acts that will be released by the government would basically help to correct this by specifically mentioning it that small company as exempted from withholding tax, so that companies, when as a small business owner you are dealing with companies, they don't have to deduct withholding tax from you. But as it stands, it could be practically challenging for you to argue with a company for them not to deduct withholding tax. Now, for withholding tax, the rate is, if you look at my right-hand side here, the rate applicable varies, and it is dependent on the type of transaction. That is why the withholding tax itself, we say it is only applicable on specific transaction. There are some transactions that you don't pay withholding tax on. There are some transactions you pay or they deduct withholding tax at the rate of 10%. There are some that they deduct withholding tax of at the rate of 5%. Now, for us to be able to appreciate this rate table, what I have here has been divided into two separate categories, which is complaints, the rate applicable to companies on specific transactions, and the rate applicable to individuals on specific transactions. Now, when I say individual, with respect to tax and with respect to withholding tax, what we are saying is that we are referring to registered businesses. It could be as long as the business is not incorporated as a limited or a PLC. So it could be a registered business name, it could be a sole proprietorship, and it could be at the same time a partnership. Any of these falls under the category of what we call individual. Now, for dividend that you receive, interest and rent, the withholding tax that is deducted when they're making such payment is at a flat rate of 10% for both companies and individual. Now, what this is saying is that if, as a company, you're trying to pay dividend to another company that owns the company, you are required to deduct withholding tax at the rate of 10%. Also, where in a situation where you as a business owner, aside from banks, so I collect a loan from, say, I run a business called Olamilekan, an enterprise, but I have collected a loan from Benga Deboale, an enterprise, and Benga has borrowed me 10 million naira, and I'm paying interest to Benga at the rate of, say, 20%, which implies that I'm paying 2 million naira interest. At the point of paying Benga the interest of 2 million naira, what you're supposed to do is to deduct withholding tax at the rate of 10% on the applicable amount and pay the net amount to Benga an enterprise. That is the requirement of the law. And in addition, rent, same thing applies. As a business owner who has a rented property that you're using to carry on your business, you're required to deduct withholding tax at the rate of 10%, and then remit this withholding tax to the relevant tax authority. Before I go on the applicable rate, I'll quickly touch on the relevant tax authority that you remit withholding tax to. So for withholding tax that is deducted from a company, so whenever as I am Olamilekan an enterprise, whenever anybody is deducting withholding tax from me, because I am regarded as an individual under the withholding tax rule, such withholding tax deducted from me will be remitted to the state tax authority. And in this instance, it will be remitted to Lagos State Internal LRS, which is Lagos State Internal Revenue Services, while withholding tax deducted from a company. So I'm paying a rent to, um, um, let's say, um, XYZ Limited, who is my landlord, and I'm paying rent to the landlord. I'm required to then deduct withholding tax at the rate of 10% because my landlord business is registered or incorporated as XYZ Limited. Therefore, I will then deduct the withholding tax at 10%, but I am required to then remit it to FIRS rather than the LRS, which is the Lagos State Internal Revenue Services, or any applicable state internal revenue services. So for instance, for someone based in Kaduna, such withholding tax that he suffers, even if the person that is paying him is resident or based in Lagos, and the withholding tax that the person that is in Kaduna's suffered, which has been deducted from the amount they are paying to him, such remittance is required to be remitted to the Kaduna Tax Authority and not the Lagos State Tax Authority. And for remittances that is required to go to State Tax Authority, it is required to be done within 30 days after the duty to deduct or after the deduction has been done. So in practice, what we mean is for all withholding tax that I, as a business owner, I have deducted from people before remitting the withholding tax, before paying them the net amount I'm paying them, I'm required to remit it. If the remittance is going to state authority, which is LRS, I'm required to remit it within 30 months after the period. So, say for instance, in January, I deducted withholding tax from people, and I'm required to remit it to LRS. That withholding tax that I've deducted, I'm required to then remit it and pay to LRS on or before end of February. Same thing for withholding tax that I will deduct in February, I'll be required to remit it on or before end of March. While for withholding tax that you are to require to remit to FIRS, which is the Federal Inland Revenue Services, you are required to remit within 21 days after the duty to deduct, right? Same scenario. I deducted withholding tax from my landlord, XYZ Limited, in January when I'm paying for my rent. Because I deducted it in January, I'm required to then file and remit the withholding tax to FIRS on or before 21st of February. For transaction I deducted in February, I'm required to remit the withholding tax on or before 21st of March. Same principle go all the way down. Now, going back to the rate, we have royalty at the rate of 10%, while for individual, it will be at the rate of 5%. So basically, royalty can come in any form as long as it is the payment you're making is with respect to royalty, which has been agreed, and you're making the payment. Also, just like the way we have for rent, hire of equipment, motor vehicle, plant and machinery is also at the rate of 10%, while withholding tax that you deduct from a business with respect to professional services, consultancy services, and the likes. If the business you are deducting it from is an unincorporated entity, that is an individual, you deduct 5%. But if the business is an incorporated entity, then you deduct 10%. So for instance, I run a business, I now want to prepare my account. I have now engaged, say, Maxwell and chartered accountant to help me to prepare my account. When I'm paying Maxwell for preparing the account, because Maxwell is is regarded as an individual because the name of the business is Maxwell and Chartered Accountant. Therefore, the withholding tax I will deduct when I'm paying him for the professional services will be 5%. However, if my accountant name is ABC Professional Limited, because the business is an incorporated business, that is ABC Professional Limited, I would then be required to deduct withholding tax at the rate of 10% rather than 5%. And then we have withholding tax that is deducted on all type of contract, agency agreement, other than sales in the ordinary course of business. Now, when we talk about all type of contract, what we are saying is that when you enter into a contractual agreement to be supplying somebody or render a service or something, and it does not fall in any of the category that has been listed above, then the withholding tax will be at the rate of 5%. However, the law says other than sales in the ordinary course of business. Now, there has been argument, or rather, there has been a space for contention with respect to what constitute sales in the ordinary course of business. But there has been a TAT, that is the Tax Appeal Tribunal judgment, which has helped to lay rest to the contention or the lack of understanding of what really relates to trade in the ordinary or sales in the ordinary course of business. So usually, before you can define or determine what your business or your trade in the ordinary course of business constitute, then you need to look at whether the transaction you are rendering to whoever you are rendering it to is the core transaction that the business is required to do, and at the same time, it is the frequency. This is what you do regularly, and it is not a one-off thing. So, for instance, a one-off thing could be I am an IT person, right? And what I do is I just provide IT services to people, because the services, which is I come to your office to come and help you to test your network and see that your network is fine, and I go back to my house. I do it for several business, because the business I am rendering is can be regarded as a technical services, that it does not fall under the category of sales in the ordinary course of business. And in Nigeria, at the same time, we don't have anything, our law does not have anything that says service in the ordinary course of business. So because it falls under the category of technical services, therefore the applicable withholding tax will go. However, where I am making a sales in the ordinary course of business. So for instance, I think I made a scenario earlier where I was referencing that I supply stationaries to people. So if I am supplying stationaries to you, and to a large extent, that is all I've supplied, and we don't have a contract that says, oh, anytime I'm supplying you, I will charge a service charge of XYZ, or anytime I'm supplying you, I will put 50,000 as my service fee or service charge or anything. In that regard, you could argue for a sales in the ordinary course of business, because what you're doing is the core nature of my business, and that is what I do regularly. Those are the kind of transaction I carry out. So withholding tax, sales in the ordinary course of business rule can apply, and withholding tax would not be applicable. Another example is I go into the supermarket to buy an item, even though no, the item is for the business. Say I will quickly need a printing paper, but we are out of the printing paper, and our supplier is here to bring it, and we rush to the stationery to quickly buy the printing paper. Now, at the point of buying it, you will not be able to deduct withholding tax, because what the person supplying you can argue to say the supply, the sales that is being done at that point in time can be regarded as a sales in the ordinary course of business. Therefore, the withholding tax will not be applicable. But in a situation where you cannot, it is not a sales in the ordinary course of business and it falls in any of the category listed above here, withholding tax will apply at the right and applicable rate. And it is essential for, as a business owner, for you to understand if your business is categorically a sales in the ordinary course of business. And a simple way of also mitigating this withholding tax could be where I am invoicing someone for supply of that stationery, and the station I'm putting it to say, oh, I'm supplying you printing material, I'm supplying you ink, I'm supplying you toner. The amount for printing material is 100,000, toner is 50,000, ink is 50,000, total 200,000. Then you can then separate it and say, oh, my service charge is 10,000. What this simply implies that all the category transaction listed above can easily be categorized as sales in the ordinary course of business, whereas the only amount that will be applicable or exposed and limited to withholding tax will now be the service charge that I'm charging you, which will now be subject to withholding tax at a rate of 5%. Remember, withholding tax is not a separate tax. It is only an advance payment of income tax. And income tax itself is only paid on profit. So if I am supplying you stationery materials and I'm telling you that, oh, the cost of this stationery material is 100,000, the cost of the ink is 50,000, the cost of the toner is 50,000. Therefore, what this simply implies is that I should not suffer withholding tax on any of these listed transactions because they are sales in the ordinary course of business and they are not expressly business income to me or profit, as we may put it. Okay, so next I will just quickly touch on some other aspect of taxes that are in respect to income and in respect to gains. So we have what we call the information technology tax, which is popularly called the IT tax. Now, IT tax is a tax that is only payable by company, I would say large company that they have a turnover that exceeds 100 million, and only companies that are listed. So it is not all company that pays IT tax. It is only company that is listed under the information technology tax law that is required to. And these are companies that are usually more of technology company, telecommunication company, IT providing company, pension and pension related company, and as well as bank, insurance, or other financial institutions. Now, for other financial institutions, the BOFIA Act included organizations such as international money transfer services, payment service provider, mortgage companies, credit companies, and essentially companies that offers credit, like a quick loan company, if that is what you do, whether you do it digitally, virtually, electronically, or even physically, you then will be required to pay IT tax. However, this would only also be paid if you then make a turnover or a profit above 100 million, and this is paid on the profit before tax. So you don't need to do any calculation before you determine what is regarded as profit before tax. This is simply just all your profits, after calculating your turnover, your expenses, you remove all your expenses, and you arrive at your profit before tax. So it is applied, it is applicable at the rate of 1% of profit before tax. And at the same time, IT tax is tax deductible. So when we say tax deductible for company income tax purpose, is that when you pay IT tax, you can take it as a deduction when you're calculating your company income tax. So in practice, because of this tax deductibility attribute of an IT tax, in practice, what we do is that when you pay IT tax this year, so for instance, you pay it in for the tax year in 2024, because the wording of the law says IT tax paid is deductible, right? So next year, when I'm filing my company income tax, I can take the IT tax that I paid this year, I can claim it back as a tax expense in calculating my taxable profit before arriving at my company income tax in next year's tax computation. So that's why it is called tax deductible. However, not all income tax that is being payable has this essential attribute. Majorly, it is only IT tax that carries such tax deductibility attribute. So I'll still come later to talk about what are the major key tax deductible items and non-deductible items. The other one is capital gain tax. Now, this capital gain tax is what we call CGT, and it is chargeable on capital gain accruing to any person or company or individual making disposable or someone that has disposed a chargeable asset. Now, what this tax is saying is that in a situation where you make gain at the point of the disposing, which is selling or even giving away your what is it called, a chargeable asset, you are required to pay capital gain tax, and capital gain tax is applicable at the rate of 10%. So the key thing is to understand what is regarded as chargeable assets. Now, the company capital gain tax has essentially made it easy by defining or identifying what are the key thing that is regarded as chargeable asset. And under the capital gain tax, what we have are the likes of commercial building. So where you have a commercial building that you rent out for commercial purposes, at the point of disposing it, you are selling the commercial building. You are expected to pay capital gain tax on the gain. So not essentially the profit. So you need to calculate and say, what is my gain? I acquired this commercial building at the rate of 20 million and I'm selling this commercial building at the rate of 50 million. Therefore, there is a gain of 30 million and it is on that gain that you are expected to pay a CGT at the rate of 10%, which will be 3 million. Moving further, other things that are regarded as chargeable assets are option, debt, or incorporate property. This could be patent right. This could be trademark. So you could have a patent right on something, and you are selling the patent right to a company. At the point of selling the patent right, you are required to pay CGT at the rate of 10%. Where you dispose any currency other than Nigerian currency. Now, this is a bit contentious, or I wouldn't say this is a bit, it seems a bit controversial to a lot of people in Nigeria. So what this is saying is that where you use you take your naira and you use it to buy or exchange to dollar at the rate of say 1,000 and you put it, you keep the dollar in your wallet and under your pillow in your bank account, and then as of today now, the official exchange rate is roughly about 8,600 naira, and you decided to sell the dollar back to naira. Now, you have gained essentially, how will I put it? You have gained essentially a significant amount as a result of the transaction, and you're required to then pay CGT on it. But a lot of people are not aware of this. I will not go further on it so that because of the current economic hardship, so that it doesn't look I'm being insensitive. But as it is, that is what the tax law says, and that is what it is. Also, when you have digital asset, i.e. cryptocurrency, and you are disposing your BTC, your Ethereum, and the like, the gain you make on it, the profit you make on it, you are actually required to pay CGT at the rate of 10%. So where, and also you have any form of property created by a person, disposing it or otherwise coming to be owned without being acquired. Now, this, what we're saying here is when a property is bequeathed to you or a property is gifted to you, bequeathed could simply mean where your daddy, your uncle, your mommy, your brother, or whoever will a property to you, and maybe you now decide to sell the property, right? You are required to pay CGT on such disposal, and again at the rate of 10%. Also, CGT is applicable on compensation for loss of offices. So when you have an employer, and that employer you dispose, or rather you sack the employer, and or you make the employer redundant, and you are paying the person to say take um um I'm compensating you for making you redundant. You are required to pay CGT at the rate of 10%. However, there is an exception to it. You will not pay CGT on such amount, provided it is less than 10 million naira. But where it is above 10 million naira, such compensation, you need to pay CGT at the rate of 10%. Where you dispose your shares in a company, right? And just like the scenario I painted with respect to Chidera, where you dispose your shares, and the turnover that you're making is above 100 million naira, you are required to pay CGT on it. Also, with respect to shares, the Finance Act say exempt any share that is disposed that is less than 100 million naira, and the total amount, the cumulative. So I have shares in say GT Bank, and I dispose all my shares, provided the total shares I dispose in 112 calendar month is less than 100 million naira, no CGT would apply. However, again, the Finance Act also went further and says CGT will also not apply if it exceeds 100 million naira, but I am reinvesting the same proceeds. So when I dispose all the shares for 200 million, like the way Chidera collected 200 million naira, the 200 million naira, if Chidera decided to reinvest the whole of that money in another Nigerian company, so maybe Chidera too is eyeing a startup in another startup entirely, and she decided to reinvest the whole of the 200 million in the startup within the same period that within the same year that she received the money. Then in that regard, such proceed from the sales of shares will also not be subject to CGT. Further exemptions are the likes of when you dispose your government securities, i.e. bond, treasury bills, or your main residential building, right? Or a dwelling building. Now, dwelling building could mean a dilapidated building that you have condemned, right? for a while, not that a building that is standing, you are making money from it, but a condemned building, and you decide to sell it for someone to make a new building, to rebuild it, to redevelop it, then such disposal will also not be subject to the I would move on to okay. So taking us away from income taxes that is applicable to business companies on their gain and income, I would move to taxes that is applicable as a result of employment and business owners, right? So we have what we call the personal income tax, right? And for the personal income tax, it is essentially levied on income of an individual or remember again, just like I mentioned during the withholding tax, that individuals in respect of the tax law is regarded to be an employee, right? Someone that works for somebody, or a sole proprietor, a owner of a business, or at the same time, people that are into partnership. So these are the people that personal income tax are applicable to, because all these people do not pay company income tax, and they are regarded as unincorporated entity. So they all pay personal income tax. And this personal income tax is applicable or usually based on what we call the residency rule. Now, what the residency rule is saying is that you pay personal income tax to your relevant tax authority, which is your state tax authority, based on your place of residence. Now, and the residency rule says to determine what constitutes your place of residence, it means you must have lived in that place within one accounting year, within 1 year of assessment. You must have lived in that place for at least minimum of 183 days. So, for instance, I live in Lagos, and I've been living here. So, provided since I live for more than 183 days in Lagos, it means my taxes with respect to personal income tax, all should be paid to Lagos State Internal Revenue Services. For someone that lives in Kaduna, such taxes should be paid to the Kaduna State Revenue Authority, right? And for a complex or a bit of dicey people that lives in places that border Lagos, i.e., for someone that lives in Bega, right? You need to determine whether the part of the place you live is considered to be part of Lagos or Ogun State. If it is regarded as part of Ogun, then such person would need to pay their personal income tax to Ogun State Tax Authority. While if it is the other, that is Lagos, you pay it to the Lagos State Tax Authority. This is all subject to within 1 year, you have stayed in a place for more than 183 days. Now, so if this year you stayed in this place, next year or before the end of the year, let's say from January to October, I stay in Lagos State. Then November, December, I stay in Ogun State. According to the law and according to the residency rule, as it stands, my taxes are still required to be paid to Lagos State until in the new accounting year, and I have decided to continue to stay in Ogun State for more than 183 days. That is when my tax authority will now shift from Lagos and shift to Ogun State. So where you have a staff that lives in between two states in one accounting year, right? Or rather in one tax year, such person, you need to critically evaluate where their taxes is liable to. So you don't just say because the person moved today to Ogun State and you start paying their taxes to Ogun State. However, you for the whole of that tax calendar year, it is advisable for you to continue to remit to the same tax authority, and you can then decide to start remitting from the beginning of new tax calendar year to the new tax authority. And this will also be subject to the fact that this person stays in this new state for at least 183 days. Now, payee, which is personal income tax, can either be paid in form of payee, which is pay as you earn, or self-assessment. Now, pay as you earn basically has to do with when you have a staff, when you employ a staff, you pay payee on such the salary you pay to the staff every month, while self-assessment has to do with business owner who incorporated a business as a sole proprietor or are in partnership. At the end of their accounting year, they are required to do a self-assessment and pay personal income tax on the business profits that they have made within that period. Now, I didn't say pays on income, but rather on business profit. So, Olamilekan Enterprise, as the sole proprietor who owns such business, all I'm required by law is for me to pay to do a self-assessment and then pay it to the tax authority. For the payee, we have a payee table that we use in determining or calculating the payee payable. And these are just as shown above, but I will just quickly move on to the other aspect, which is the filing. For payee, the filing of annual return is required as a business owner to file your payee annual return for your employer. So it's basically saying all the payments you've made in 1 year for this person, you summarize it and then file a return with respect to it. And this is required to be done on or before 31st of January each year, while the individual, where if you're doing a self-assessment, you're required to file your self-assessment return on or before 31st of each year, 31st of March each year. And similar to income tax and company income tax, we also have the minimum tax for personal income tax. With respect to the minimum tax, a company is required to pay or rather, an employee is required to pay minimum tax on their gross income of 1%, provided the amount they are paying or the amount computed is less than the minimum tax. So if you calculate my payee and my payee is 50,000, however, when you calculate 1% of my gross income is then the minimum the 1% is 60,000. It then means that the tax you are supposed to pay in that accounting year should be in that tax year should be 1% of your gross and not the 50,000 pay, because the 50,000 is lower than the minimum tax of 1% computed, right? However, anybody that earns minimum wage is exempted from minimum tax. For the penalty, again, it is 10% per annum for the amount unpaid and the interest, while for late filing of annual return, it is a fine of 500,000 for a company and 50,000 for individual. So as a business owner, if you don't file the annual return for your business, you will be charged a fine of 500,000. While if you don't file your self-assessment, you'll be charged a penalty of 50,000 for the late annual return filing. Moving on, also we have the taxes that is paid on value-added tax, which is VAT, and this VAT is only chargeable on supply of taxable goods and services that is done within Nigeria. Now, the only types of business that is exempted, or services and supply or goods and services that is exempted from VAT are the ones listed in the first schedule of the VAT Act. I've picked a few one and put them on the right-hand side. However, we have a whole of them which are all listed in the first schedule. So if you want to get a full list, you can check the first schedule of CETA. So if you are a business owner and or what you do or what you sell is basically basic food items, you don't charge VAT on your invoice. Also, if you do medical or pharmaceutical products, and that is basically what your business entails, you don't charge VAT. If you produce books or educational material, same with baby product, or you run a nursery or a school, an education institution entirely, you don't charge VAT when you are collecting your school fees from your pupils or the parent. To a large extent, the Finance Act has tried to make life easy for people and simplify the VAT treatment in Nigeria. As a result, VAT is only charged at the rate of 7.5% of the value of taxable supply or goods. So if I'm supplying a goods, as long as the goods I'm supplying is not listed in the first schedule, then I will charge VAT at the rate of 7.5%. Or as long as the services I'm rendering is not listed in the first schedule of CETA, I will charge VAT at the rate of 7.5%. Now, the Finance Act has made it a bit easier. Again, for small company, they don't need to charge VAT on their services or supply. So again, the small company is regarded as a company that makes 25 million or less, right? So as a small company, you don't need to charge VAT. And but the only thing you are required is that you, as a small company, the moment your business or your revenue exceed 25 million, then from that moment onward, you are required to charge VAT, right? And the Finance Act has made it easy for, as a business owner, a small business owner, not to charge VAT, and at the same time not to file VAT return. But remember, if at the beginning of January and your year end is December, by October, you have made 25 million. From any sales you are making onward after the 25 million, you are then required to charge VAT. You are then required to file VAT return every month. And luckily, the Finance Act has also made it easier that VAT is only applicable on is now charged on the basis of is on cash basis. So before now, it is done on accrual. So I pay VAT on my invoice, but now we only pay VAT on the money that you have collected. So I invoice XYZ for a sale for supply of goods, and the VAT on it is 7,000 naira. I will not pay the VAT until when I have received the money from the person I supplied it to, along with the total sales and the VAT. So when the person pays me the total amount, I then pay the VAT to the tax authority. The due date for filing of VAT is 21st day of each month, of subsequent months rather. So for transactions that happen in January, by 21st of February, you are required to file VAT. Same thing for transactions that happen in February, by 21st of March, you are required to file the VAT and make the payment, right? other aspect is we have stamp duty, then we have consumption tax, which is applicable to people that do that render hotel or facility that provide events and restaurant services within Lagos State, and they provide these services to people. People coming into their business environment, and they consume items within the business along with the rent room or the stay in the hotel and the likes. You are required to charge consumption tax along and this consumption tax is separate from VAT, and it is charged at the rate of 5%. Now we need to understand that there is a separate distinction between VAT and consumption tax, and at the same time we need to appreciate the fact that consumption tax and VAT is not a tax that is paid by the business, but rather it is a tax that is shifted to whoever you're supplying your services to. So it is my customer that pays the consumption tax as well as the VAT. Also, we have what we call the business premises levy. So in Lagos State, as a business owner, if you have a business that you use in, you have a building or a premises that you use in generating your business income, you're required to pay 10,000 naira for levy as your business levy in the first year. And then on subsequent year, you'll be required to pay 5,000 naira for each renewal. Also, we have what we call the development levy, which is at the rate of 100 naira for each taxable person in the state. So every year, if you employ staff, you have to you have to pay 100 naira for each of the staff that you've employed within 1 year, along with yourself as a business owner. The business itself does not pay development tax, but it is the taxable people that you have in the business that pays the development levy along with the business owner itself. Okay, so talking about the allowable and allowable items which are deductible for tax purposes, right? The key thing to look out for when determining things that are allowable for tax purposes are is what we use the test that we call the Warren test, and this Warren test simply says you should look at the expenses that you've incurred, whether it is wholly incurred. Wholly means is everything incurred for the business. If you incur some of these expenses for your personal use, therefore the portion that is for your personal use will not be allowable for business when you are computing your company income tax or personal income tax. It has to be reasonable, right? Reasonable in the sense that you cannot tell me that the total revenue you make in 1 year is 28 million naira. However, you are paying a rent of 40 million naira alone. Then in that instance, the rent itself is not reasonable. And as a result, the tax authority might not allow you to even claim it as an allowable expense. Also, exclusivity, right? When the expenses you incur must be exclusively incurred for the business. Why? Now, this exclusive, it must be in a form that you incur this expense because you are using it to then generate business income. As a business owner, all expenses you are incurring should allow you to be able to make profit. You don't incur expenses for the sake of incurring it. And lastly, we look at the test of necessity, right? It has to be necessarily incurred, right? You cannot tell me you are a business owner and you have just 5 staffs and you decided to buy 100 laptops for your business, right? There is no way you can tell me that such expenses is necessary because you only have 5 employees and your business does not even or cannot even accommodate such expenses. So for every expenses that you incur, you must test that it meets this warrant test, and any situation where each of the expense does not, then such expense stand the chance of being disallowed by the tax authority. And when they are disallowed, it then increase the possibility of you paying more taxes rather than you paying the right amount of taxes. And other examples of allowable expenses, which for the business or things that are deductible under company income tax and personal income tax, are capital allowance. Now, this capital allowance is an allowance that is taken in lieu of depreciation. Now, in accounting, when you buy an item and it is of a capital nature, you are expected to capitalize the item. You don't put it in your P&L and expense it, and then you depreciate it over a period of time. So what the tax law is saying is that because there is a bit of inconsistency with respect to how depreciation is done, because people are allowed to use different types of depreciation method, then the tax law would disallow the whole of your depreciation and then allow you to claim capital allowance on such qualifying capital expenditure, capital item that you have acquired, right? And then the interest you incur on your business when you borrow money, you are allowed to claim to deduct this interest for tax purposes, right? However, this interest is restricted to 30% of your EBITDA. Now, in accounting, what we call EBITDA is earnings before your interest, earnings before your interest, tax, depreciation, and the likes, right? We usually use this to determine the business performance. So because of that, it is then the interest is usually restricted to this EBITDA, the 30%, so that they can be able to see that the interest you are paying on loan meets the level of the business performance itself. You don't go and collect a loan of you don't collect a loan and you are paying an interest that is even above your total business profit or revenue at the end of the day. Also, wages and salary that you pay to your staff, reimbursement where you send your staff to say, please go to CAC and go and submit the document, and the person comes back from CAC and the transport fare the person incurs 20,000 naira or 2,000 naira, that you can reimburse such money to the staff, and it is allowed as deductible when you're calculating your tax under CIT or personal income tax, as well as rent, your bad debt, repair and maintenance that you incur on your businesses. For things that are not allowed, we have the likes of personal expenses, like we mentioned when we are talking about WOLI under the warrant test, capital expenditure and depreciation, general provision, fines and penalty that you pay. All this will not be deducted when you are calculating your tax payable. So when you pay fine, you're still going to remove it, which then increases your amount of taxes that you are going to pay, as well as taxes paid on income or profit levied in Nigeria. This is in exception to IT tax, which I mentioned earlier, that you are allowed to claim deduction on it. And other credits available to a business is your withholding tax credit note. Earlier, I did mention that for withholding tax, you pay withholding tax, they deduct withholding tax from you, but you can claim it when you're paying your company income tax. But for you to be able to claim it, you need to get your withholding tax credit note from whoever. Luckily, the likes of the FIRS and the Lagos State Internal Revenue Service, they've tried to automate and improve on the collection of withholding tax credit note, that you can automatically see it on your portal inside the Tax Pro Max or the the Lagos State e-tax platform, and you can you can easily apply this credit note when you're paying your company income tax or personal income tax during your self-assessment. Then you have bonus as a result of paying your taxes in advance. So where you pay your taxes in advance, 90 days before the due date, and you've paid everything, you can claim up to 2% or 1%, depending on whether you're a medium-sized company or a large company in any in subsequent year. So if I do it this year, next year when I'm filing my return, I can claim the bonus of either 1% or 2%. So just to quickly look at for a business owner, for someone that wants to start a new business, there are some things that you actually need to consider at the point of starting the business. And in considering this, it is essential to also sorry, excuse me. So as a business owner, it is essential to consider all these implications before deciding to start the business, and at the same time before selecting the business structure. Now, business structure could easily mean whether you should make it just register a business name, or you register as a limited company, or you just carry on the business as an individual by yourself. So, and things that are generally required for you to consider as a business owner that wants to start a business is to look at the cost of setting up the business structure, i.e., whether the cost that is you're going to incur to set it up as a limited company or just register a business. The licenses that you will need to get if your business will need you to have a business permit, a license permit, or anything. And then the taxes that you'll be paying and the tax authority that will be involved. So whether you will be paying XYZ taxes, and will you be paying it to FIRS, or will you be paying it to the state authority, or will you be paying it to both the FIRS and then your state authority? Others are the potential personal liability cover, the legal requirements that is going to be associated with the business. But what I want to focus on will be the tax impact itself. So I'm looking at the structure of being a sole proprietor or a partnership, and then things you need to look out will be the payee, which is the personal pay as you earn, that you'll be paying on the salary that you will deduct on the salary you're going to pay to your staff. The direct assessment that you yourself as a business owner that you will be paying, whether your transactions will be subject to withholding tax, right? And at what rate, or there's a way you can manage your e-invoice to ensure that if you have a sales in ordinary course of business, you don't suffer withholding tax on such sales, right? And then capital gain tax where it is applicable, when you are disposing the business, when you do some other transactions, and you make chargeable gain, or you dispose your chargeable assets, right? And mostly for a sole proprietor or a partnership, your taxes are usually going to be paid to your state tax authority, which is for people in Lagos, you will be paying mostly and all of your taxes to LRS, right? And when they deduct withholding tax from you, it should be remitted to LRS and not FIRS. While for incorporated entity, which is limited and PLC, your taxes will be remitted to FIRS, while some things will be remitted to LRS, i.e., when you deduct PE from your staff, you have to remit it to LRS. When you pay director fee to your staff, to the directors, you're supposed to pay on it and remit it to LRS, right? Some of the post-incorporation activity that is required as a business owner, the moment you incorporate your business or you've registered your business name is that you should quickly register for your TIN with FIRS and also register for your taxpayer identification number with LIRS. At the same time, if your business is going to be a medium or a large business, you register for VAT. Also, you need to register online to gain access for your business on FIRS Tax Pro Max. That is if it is an incorporated entity and you are going to be transacting with FIRS and it could be LRS only, or you could have to register with both LRS and FIRS. And the LRS portal is what they call the e-tax portal. So with the e-tax portal, you can generate your PID for your business, for any of your new staff that joins you and they need to register and have their own LRS PID. You can generate it so that you can use the PID to then pay their payee. And you can always log on online through this portal, both the FIRS and e-tax portal for LRS, to remit, file all your returns, withholding tax, pay, annual returns, do your company income tax and everything, and file your return and even make your payment directly online. Lastly, I'll be touching on the key, or rather the fundamental tax planning that every business owner should have at the back of their mind when running a business. And one of the key thing is to apply a separate entity principle. Now, applying the separate entity principle simply means you should separate your business and your business finances from your personal finances. So you don't dip your hand into your business pocket and be using it to run your personal expenses. You want to pay for your GoTV at home. You want to pay for your DSTV at home. You want to go for shopping at home. You don't use your business account to do that. You separate your business expense from your personal expense so that at the end of the year, you can know how much you have made for the business and you can easily be able to pay taxes on such, right? And this will allow you not to expose yourself to overpaying taxes at the end of the year, where things that you could easily be and have been allowed for tax purposes would then be disallowed for tax purposes. Also, be aware of your tax obligations. So when I say be aware of your tax obligation, it means for you to have the basic tax knowledge that revolves or that surround your business. So you need, as a business owner, you need to identify what are the taxes I'll be paying, whether I'll be paying VAT, whether I'll be paying, they will be deducted withholding tax from me, whether I need to pay income tax, whether I need to pay education tax, whether I need to pay IT tax. You need to have basic knowledge of all these taxes. And at the same time, you need to know the tax authority that you are essentially involved with. And then also, in addition, you need to stay informed in the sense that you need to know when there are changes in the tax law. In Nigeria now, for the past 3 to 4 years, we've been having updated Finance Act, which regularly changes or introduce new taxes or updates the requirement of an existing tax law. So keeping yourself informed, attending seminars, looking out for information about new taxes and trying to digest understand the impact on your business is essential way of ensuring that you don't expose yourself to taxes that you are not supposed to pay, and you don't expose yourself to paying defaulting when it comes to your tax obligation. Also, as a business owner, you need to develop a compliance calendar. Now, when we say this compliance calendar, it means you need to create a tax calendar that tells you, oh, my withholding tax is due to be remitted by so date. My company income tax is due to be remitted by so date. My annual filing is going to be done on so date. So when you have a calendar like that, it triggers you, it keeps you up at your toes, and it reminds you once it is time that all those filing or payment are due, and you're able to file them at the right time and pay them and avoid unnecessary penalty at any point in time. In addition to this tax calendar, you need to keep what we call a tax payment budget, right? Now, when as you're doing the calendar, you know that, oh, my CIT, company income tax, is due in 3 months. My personal income tax on my direct assessment as a business owner is due in March, and I'll be paying I made a profit of 500,000 naira. So you can, every month or every quarter, you can be calculating your tax liability. And then when you say this quarter you calculated it and your liability is about 50,000. So it means in your bank account, you need to keep a cash of 50,000 naira to make sure that when it is time for you to pay your taxes, you have the 50,000. It's not that you have used it to run the business or to do some other thing. So when it is now due date that your calendar has reminded you that it is time to pay for this, you have enough funds to be able to pay the tax that is due as at that time. Also, you need to have a proper internal control. This internal control allows you to keep record of your financial information, because essentially in having a good tax planning, it is essential for you to make sure that you keep record of your transactions. And under the law, there's a statute bar that allows the tax authority to go all the way 6 years to check all your information, your tax filing, your accounting and finances. So if you don't maintain a proper internal control that allows you to keep record of all your information, you will not be able to provide this document at request whenever the tax authority is saying, please, can you give us this information? Can you provide this document? So please, it is essential for you to manage your business internally, and in managing it, keeping proper documentation is essential. And another simple and most important thing you should do to avoid exposing yourself as a business owner to overpaying your taxes is to always engage tax professional. When I say engage tax professional, mean you should seek professional advice from certified tax professional, and let them always guide you when you are making any transaction or you're about to enter into a new transaction, like the case scenario of Chidera. I did bring Chidera when she received the contract from the insurance company. She seek professional advice. A tax person would have been able to tell Chidera that, sorry, Chidera, you will be paying more if this thing is worded in this way. This contract, can you ask them to change it in this way? It still meet the objective of the insurance company. However, you will only be paying XYZ amount. But because Chidera did not seek professional advice, she was exposed to paying over 20 million naira when she could have easily paid just 10 million naira CGT. And lastly, which is very important, is for us to have an open communication with tax authority. Remember, you need to know the tax authority that you are involved with. You need to know the tax authority that you need to pay your taxes to. At the same time, it is important for you to have an open relationship with them. Now, this tax authority, they are not evil and they are not devil. If you can easily even call them to say, sorry, I want to do this. I don't know how to do it. Can I do it this way, or what can I do? And they will guide you on what to do at any point in time. So having an open-minded relationship with your tax authority goes a long way in ensuring that you don't expose yourself to unnecessary taxes that you could have avoided. But people tend to believe that letting the tax authority to know I exist or letting them to know about my business could expose me to more problem. But in truth and in practice, it is the other way around. Knowing even is like knowing your tax people is like knowing your bank account officer, right? So if I don't know my bank account officer and then I have issues with my bank account, I walk into the banking or I can be tossed around, do this, do that. But you can imagine I can call my account officer from the comfort of my own. Oh, sorry, excuse me, my token is not working at the moment. Can you kindly help me to look at my token? And they will tell you, okay, they'll get back to you. Oh, we'll send a new token to you, right? That's the same way a tax authority, a tax man is. So, oh, you try to log into your portal, it's not working. You can call your tax authority and say, oh, this, that, and they tell you what to do. Oh, I'm trying to file this return, but I'm not getting this. This is what I have, this is what I'm thinking I should do. And they tell you, oh no, this is the way you're supposed to do it. A taxman or the tax authority does not, it doesn't mean they are looking for you to pay more than you should. Rather, they too, they are out to make sure and ensure that you only pay what you're required to pay. For if you've paid your taxes, a tax authority man will not be chasing you to pay what you have not paid for. And in having an open communication and fostering better relationship with them allows you to easily get your tax clearance certificate when you need it. Like the FIRS now, the tax clearance certificate is online. You can easily automate it as long as you pay your taxes for the preceding year. And you can imagine where you log into your FIRS portal and you're unable to get your tax clearance certificate. But you could easily ring your tax authority and say, oh, this is, and they look at your portal and they say, oh, sorry, it's a system glitch. We'll reset it and you can download it. So as a business owner, it is essential for you to have this key principle at the back of your mind, and they fundamentally allows you to be able to plan yourself properly and be able to have a meet your strategic goal for the business that without having any challenges with respect to tax and tax matter, unlike the way Amza had in the initial scenario where he doesn't pay taxes, he doesn't have any information, he doesn't know of his tax obligation. And at the end of the day, Hamza was unable to make a simple profit of 4 million on one transaction. That brings me to the end of everything. Thank you all. And I'm hoping that to a large extent, we've been able to basically have understanding of overview of the applicable taxes that are as a business owner you should be aware of that can impact your business, and at the same time taxes that you are required to file as a proper taxpayer and meet your tax obligations. So I will hand over back to Martha, and we can take it there from and answer any question that is that has been asked. Thank you.
Oh wow, Mr. Olamilekan. It was like we're not going to end this session. It was really a fantastic session. I must tell you the truth. Yeah, it was an eye opener even for me. And I believe that every participant on this session has learned a great deal. Yeah, we have really learned from you, and we really do appreciate your uh, well detailed and highly simplified um, presentation. Thank you so much. Because our time is fast spent, we'll just go straight. I was actually going to summarize what you have said, but our time is far gone, and we should just go ahead with the question and answer. So, thank you so much, Mr. Olamilekan.
Yeah.
An anonymous attendee wants to know how we file returns. I believe he has done justice to that, but probably we just want
Yeah.
to give more emphasis on that within
Yeah.
few seconds. How do we file returns?
So for filing of returns, it can be done electronically and it can be done physically. But to a large extent, because all our tax authority, they are beginning to, or they've moved towards digital and electronic filing. We are all encouraged to file our return digitally and electronically. So for filing that has to do with FIRS, the FIRS has a portal called the Tax Pro Max, right? As a business owner, all you need to do is to register for the Tax Pro Max portal. And then once you register, it's an user-friendly, easy environment, easy to do, one-click portal that allows you to log in and file whatever return you want to file. Similarly, the Lagos State Internal Revenue Services, LRS, they also have the portal called the e-tax portal that you can log in, file your return. Even the Lagos State even went further that if you register on the e-portal and someone deducts withholding tax from you and they remit the withholding tax to LRS, you get an automated email that comes to you to say Olamilekan Limited has deducted withholding tax of 20,000 naira and it has been remitted to on your behalf. So all filings are they can still be done using paper, but it is more efficient as a business owner for
Yeah.
you and for your business because you can keep easy record online of all this. So all you need to do is to register for both the FIRS and Tax Pro Max, and at the same time register for LRS e-tax portal.
All right. I believe anonymous attendee, your question has been answered. Just go online and register on both the FIRS and LIRS portal. And the next question from Mr. Ayo Ayeni, he wants to know how to file. I think that has been answered. Okay, no. He wants to know when to file his returns if the company was just registered. I think that's what he's trying to ask. So
Yeah.
his company was registered in September. He wants to know how to go about filing his returns.
Yeah, so I think I mentioned it earlier also in this slide.
Yeah, you did.
So if you have a new company and you want to file your return, now you have up to within 18 months of the date of your incorporation or 6 months within the date after your accounting year end, and whichever is earlier for such new business to file it. Now, what that law is saying is, I'll try and break it down, is that so for you that you've incorporated your business in September, if you decide to say, oh, for now, I don't know when my year end will be, and then you come, that means you have all the way to 18 months to file the return. But you that you started your business in September and you say my year end will definitely be my year end will be December, right? I would want to be using December. So which means your first account will be from September to December. Once you reach that December, it means you have from January all the way to June, which is 6 months to then file the return. So that's what the law says. 18 months from the date you incorporate the business, or 6 months after your first accounting year. So, and the law says whichever is earlier. So you will now be the one to check whichever comes earlier.
Okay, I hope that answers your question. Anonymous attendee also wants to know if you have not made any money, that you've not made any income, or you have not even started operating the business, but you have a CAC. You have registered the business with the Corporate Affairs Commission. Do you still need to file your tax returns, or what do you do in that case?
So there are two stages to it. You could have registered and you have your CAC certificate. You've not made business income, but your business has commenced operation, right? In that regard, you will be required to still file. However, where your business is yet to commence operation, what you need to just file, you don't need to prepare any computation. all you need to just file is what we call statement of affairs. And you continue to be filing the statement of affairs every year the company is in existence, right? Which is just a balance sheet that just shows this is the owner equity. This is the amount I used to start the business. This is my contribution, nothing more. I've not started making profit. I've not started making revenue, and my business is yet to commence operation. So you will be filing just a statement of affairs each year up till the period you now say, oh, my company is coming, my company is coming, sorry, excuse me, my company is commencing operation today, or my company is going to commence operation in April. But prior to all the time you are here to commence operation, you don't pay tax. And before now, FIRS used to charge what we call pre-operational levy. But with the advent of Finance Act and everything, that has now been put aside. So you don't pay all the pre-operational levy. All you need to just do is to prepare, get an accountant. It could be a 2-page, a 3-page. Even the accountant can make it a 2-page, a 2-pager for you to just say a statement of affairs. A statement of affairs is just a report that just shows the stagnant position of the business. I am here to commence business. I only have share capital of 500,000 naira, nothing more, right? So you don't pay taxes if you are here to commence business. But if you've commenced business, you then need to file your returns, and you also will not pay taxes if you are making loss, because as a new business, you have 4 years from the date of your commencement, and you will not be subject to minimum tax. And because you're not making revenue, it means you're making loss. You also not be paying any taxes.
All right, thank you very much. Moving on to Ahmed Owolabi. He wants to know if as an enterprise is expected to file its annual tax returns to FIRS or LIRS.
No?
I
And,
think you have mentioned that,
yeah,
yeah, because
yeah. An enterprise does not, and as an enterprise business owner, you only file your return to LIRS. Now, the return is in two phases. If it's just only you, right, then it means your return will be the one that has to do with the self-assessment, which is due on or before 31st of March. However, if you have a staff, you employ people that you've been paying salary, then you need to file their own return on or before that 1st of January each year. But for you as a business owner and the enterprise, you file your own 31st of March each year.
okay. Solomon Oyeniran has a very lengthy question. Probably I'll just summarize. So he wants to know how to calculate pay to be paid to LIRS on his employees. He actually gave a scenario. He has 2 employees that are paid 30,000 naira each on a monthly basis. So he wants to know how to calculate um, pay on each of those employees. And I think he even has 3 questions. Probably we should take it one at a time. So do you
Okay.
want to answer this first, then we'll move
Okay.
on to
So,
next?
sorry, can you confirm how much did they say he pays to each of them?
30,000 naira.
Okay. So because he pays 30,000 naira to each of them, he is not required under the law to pay for them, because what they earn is what is regarded in Nigeria as minimum tax, right? A minimum wage rather. And because you earn minimum wage, you don't pay personal income tax when you earn minimum wage. You only pay personal income tax when you earn more than the minimum wage. However, say for instance, he's paying them more than the minimum wage, so 50,000 naira, right? So he's paying them 50,000 naira every month. What he needs to do is 50,000 naira every month would, if we bring it together in 1 year, would totally mean 600,000 naira annual pay that he's paying them. Now he needs to deduct before determining the applicable CIN, personal income tax rate, he needs to deduct what we call the consolidated relief allowance, which is usually the higher of 200,000 and 1% of gross income plus another 20% of gross income. So the person that is making 600,000 annually, right? Such person, you would first of all say, what is usually what I just tell people is to do 21%, right? 20% of 600,000 will mean 120,000 naira. So on the 120,000, right, plus another 1%, which is another 60,000, which brings everything to 180,000 naira. On the 180,000 will be minus from the 600, which will leave us with 420,000. So it is the 420,000 that you are now going to apply the personal income tax rate on. Now, on the person first 300,000, you apply 7% on it. And then the remaining balance of 120, you apply 11% on it. So 7% on 300,000 will give us 21,000. 11% on the remaining 120 will technically give us, sorry, pardon my mathematics, might not be right, but let's just say 12,000. So it brings everything to 32,000 naira. That means annually, it is 32,000 naira that the person is required to pay as personal income tax, except if you pay pension for the person. If you pay pension, you also do. But usually, a small business owner like that might not be is not obligated or required under law to be paying pension if you have less than, I think, 10 staff or thereabout. But assuming you're not, but so the 32,000 that we've calculated, because it's annual, and remember we said the 50,000 is also monthly, but we made it 600,000 annual. All you then need to do is to say, what is 32,000 going to be every month? You then divide 32,000 by 12, which in another poor mathematics from me, let's just say it's going to be 2,200. Now it means every month when you are paying your staff 50,000, you need to minus 12,200 from me, and then you remit 12,200 to the tax authority each month for that person and pay the person 47,800 every month.
Oh, wow. I must say this is a school of taxation. Yeah. Really, I've learned a lot personally, and I also know that our participants have learned so much from your wealth of experience. The second question, yes, you have answered the second question in one way or the other in your previous responses. I will just go to the last question. So he wants to know if returns will be made on the total income or on his profits.
When you're making return as a business owner, you're going to make return. The return is going to show both your total income, all your expenses for the business that is allowable, as well as your profit, business profit. So it is on your business profit that will now apply the same breakdown of that personal income tax rate on it. So in your return, it will still show both your income, your expenses, and remember in accounting, income minus expense is what gives us profit. And it is on the profit that you then apply whatever taxes that you need to apply on it.
All right, thank you, sir. Excellent. Epele wants to know if the exercise of an employee option under an employee share option plan be chargeable to any tax to the company or the employee.
Again, when it comes to employee share option, right? The taxman would not quickly just jump at it and say, and this is a tax you're paying on it. the taxman will first of all understand what the agreement of the employee share option is, and at the same time, what is the accounting implication. So in some instances, just like the scenario of Chidera, right? Employee share option could, depending on the wording of the share agreement, could trigger what we call post combination, or and it could trigger what we call compensation, employee compensation, and at the same time it could trigger what we call just a simple share consideration, right? So usually we would not tell you whether it is going to be PI personal income tax you will pay on an employee share scheme, or whatever tax you pay. But it is usually good to assess the share option contract and be able to confidently determine what the tax implication will be. But to a very large extent, a share employee share option, you don't usually tax it up until the employee is disposing the shares, right? It is at that point of the disposal that will now tell you, oh, the money you made is actually an, an income to you, is a compensation. So payee, personal income tax will apply, or it's just a normal shares you are disposing, and CGT will apply. And in further drilling, at the point of CGT applying, it could even be that you'll be exempted because it does not meet a particular threshold of CGT, i.e., it's not up to 100 million, or you are reinvesting the amount in another shares in Nigeria, So usually what we tell people when it comes to employee share scheme is to seek professional advice at the point of either entering the share scheme or disposing the agreement, or disposing the shares itself.
Mm. Oh, wow. Thank you, Mr. Olamilekan. You have really, really been impactful. Yeah. In fact, it's the way you have been able to simplify the whole thing. Probably if I've taken your slides to go through it myself, I may not be able to understudy the way you have presented. And we are really grateful for your wealth of experience and knowledge. Thank you so, so much. And for our participants, we also want to appreciate you for your time. I know we've spent over 2 hours, and we are we should have ended the session, but I know it is all worth it. I know it is all worth it. And also, it is very important to know that peradventure you want to go back to, probably you missed out some things, or you want to study more, because I actually call this School of Taxation. You can go to our YouTube channel at LSCTF to watch. You would also be privileged to have the slides. For those who register, the slides will be shared to you at the end of this session. Thank you so much for being a part of this masterclass. And also, we are looking forward to meeting you or to seeing you at our next masterclass, which will be happening soon on financial management opportunities for women-owned businesses. We are sorry, we are not trying to be gender biased, but it is what it is. So it is going to be for women-owned businesses. Keep tabs, keep finger crossed. Follow us on all our social media handles. You will get further details and information concerning that masterclass. And just like today's Zoom, it will even be much more exciting than you would expect. Thank you so much. Thank you so much for joining us. Mr. Olamilekan, do you have any last words for our listeners just before we wrap it up?
Yeah.
Probably you just want to give us one or two things to go home with.
Thank you very much. Just to reiterate on my last comment, which is as a business owner, it is essential for you to know that having a good relationship with your tax authority is the key to your tax compliance. Avoiding a tax authority is the beginning of a tax problem. So it is I would always say it, and will always say it everywhere. I remember in my days in PwC, it is one of the easiest and the simplest thing we do, which is make sure we have relationship with the tax authority. There are some simple things you could do that you could easily ring them up and they will tell you what to do, and it saves you more than necessarily just avoiding them for unknown reason. And also try as much as possible as a business owner not to fall among the 55% business owner in Nigeria who at the moment does not pay taxes. Paying your taxes is part of helping the economy, and it is part of why you set up the business in the first place. Thank you.
Thank you so much. I just wanted to wrap this up with the fact that sometimes opportunity lost may never be regained. The first scenario Mr. Olamilekan painted about Abib also, I don't know if I got the name correctly. He had a business opportunity, but he eventually lost it because he wasn't tax compliant. So I just want to admonish or motivate each and every one of us to ensure that we do the needful. Do not run away from your tax officers. Do not run away from your tax consultants. These are things you need to put in place in order for your business to enjoy or to get investors, to get investment, to get grants, to get loans. So you can not run away from the fact that it is very important that you need to be up to date with your taxation. Thank you very much. Let's go back, put to practice everything that we have been taught. Go back to the videos and to the materials and ensure that we are doing the needful. And I wish you all the best. I wish you all business growth and expansion. I wish you all safety and enjoy the rest of your day. Bye. Mr. Olamilekan, bye. Thanks for joining us.